It's great to have everybody here. It's great for people that have joined us in the past. We've done a few of these Learn at a Distance Brunches with Bruiser series. My name is Ryan Broussard. I'm the VP of Production Incentives and Sales at Media Services. My colleagues and my boss gave me the nickname Bruiser when I started. I don't know. I liked it. It stuck. And and Brunches with Bruiser just sounds good. So what can I say? We've been doing these, and as I mentioned, they're a little laid back. They're kind of fun, so it's really not uppity. If you guys have questions as we go through things, please send them over. Please send your comments, your questions. I will try to answer them as they come through. If I'm not able to answer anything, I'm getting a report of all the questions that are submitted. So, please be aware that I will reach out to you after the fact, and this webinar is being recorded. So if you guys want to revisit it or even want a copy of the PowerPoint or something like that, just shoot me an email and I'll get you as much information as I can, okay? All right, so let's get right to it. So today we're talking about California. California has had this program. This is its third version of this program. It's version 3.0, and it just started on July 1st, so it's brand new, okay, to everybody. It's funded at $330 million. So what that means is they have $330 million worth of credits to allocate out to applicants that pass everything we're going to talk about today and are awarded the credit. So that's how much money they have, and it's divided up amongst the production types, which we're going to talk about. So version 2.0 was successful. Version 3.0 has a lot of great new additions and changes. I'm super excited about it. I'm super excited for my clients. A lot of the independents now, this is going to be catered to you guys. Well, not completely catered, but there's going to be some new additions and new changes that are really going to help you guys. So let's get going. They divide up the credit in two ways. It's kind of interesting. So independents have a fully transferable credit, okay? What this means, if you guys have never encountered or worked with tax credits before, it means that they can sell the credit. Why is this important for independents? It's extremely important for independents. And by the way, I see a lot of questions coming in. What are independents? What's the non-transferable? What's the asterisk mean? I'm going to get into all this stuff. So sit tight. Hold on to your vegan, gluten-free margarita, because we're gonna get to it. I promise. So the asterisks do mean that it's brand new to this program versus the other program. So if you see that asterisk, like you see on this page, that means it's new, and I recommend that you take a bite of your brunch or a sip of your drink, and by the end of this, you're going to be on the floor, but you'll be very educated on the program. So, okay, transferable means that they can sell it on the open market when they get their credit. So when they pass all the applications, everything that they need to do, which we're going to talk about, they get a credit that they can transfer and sell to an unrelated party on the open market. This is important because for an independent perspective, yes, 3.0 is effective now. It's effective now. July 1st is effective now. People are asking, effective now. July 1st, it's now. We're here. 3.0 is here. It can sell on the open market and get cash quick, which is important for independents because they want to pay off their loans, their debts, if anything was financed against it, free up cash flow, things like that. Okay, that's only for independents. It's extremely rare in this program. It's the only production type that can get it. Okay. Someone asked what the transferable rate is. It's 94 cents on the dollar. Last I checked. Of course, the world is different now, so we will see how that goes. But if everything stays the same, that's what it's at, and we're going to talk about that towards the end. Okay, guys. So the other type of credit is a non-transferable, non-refundable credit. This is for all other types of productions that are accepted into the program. What does this mean? This is actually the first time we've encountered this type of credit with the states that we've talked about in the past. This means that they cannot sell it, so they cannot transfer it, And they also can't get a refund from the state. A lot of the states we've talked about in the past can get a refund of cash. They can't do that. It can only be used to offset income tax liability. And actually, in California, in some instances, sales and use tax liability, which is pretty interesting. And we're going to talk about that. So that's the differences between the credits. So I'm going to move on because we have a lot to cover. And we are going to kind of revisit these numbers and these terms. So bear with me, okay? All right. Okay. Let's talk about this first. So this is the important stuff. This is food. This is what's important to me. I know everybody wants information, but we got to break this stuff up. We got to have a little fun because it is so much to absorb. So in Brunches with Bruiser, we always talk about a recipe or, something fun with regards to a mimosa, margarita, something like that. I suggest a margarita today since we're talking about California. And then for recipe, I'm going with the avocado toast. I always think of green and bright when I think California and eating there. And I will tell you this recipe, and this I do every day. Every single day I make this. I found to make it myself. And I've gone the quarantine route of hitting up Trader Joe's. They have the best sourdough bread. You've got to use that sourdough bread. You put it in the fridge. It comes back like magic. Put it in a cast iron pan, whatever. And then add your avocado. And then I do an over medium egg. And then here's the kicker. You ready? Here's the kicker. The everything bagel seasoning at Trader Joe's. Man, that's the magic. Come on. I know you guys have had that or you've heard of it. Yeah, there you go. People talking about it. There it is. This stuff is great. So that completely changed my avocado. Sometimes I put some chili onion crunch on it, which is another Trader. Trader Joe's should pay me. They should sponsor these webinars because I talk about them quite a bit. Somebody said they put salami on your avocado. Hey man, look at this picture. To each their own. Whatever somebody wants. Some lox. Yeah, that's what we're talking about. So hopefully you guys are eating something because these always make people hungry. All right, so we're going to move on. We've taken the bite, taken a sip of a drink, hopefully, and now we're getting into the meat of the program. So let's talk about the big picture of kind of how they divided up everything. Somebody asked earlier, is the $330 million, does that include independents? It does. Look at this chart. So they have included all these things in the $330 million, and they've divided it up as best they see fit. And it actually is divided up a little differently than it was last time, for the better. I personally think for the better. Because independents now are sitting in a much, much better place. And we're going to talk about why. But you can see here that independents now on this chart have a division of 10 million and below. They get a certain amount, and 10 million and above. Okay. And an independent film, that's going to be somebody that's not non-indie productions, which you'll see above. The independent films are going to be somebody, I believe they define it as long as your production company or the company that's applying doesn't have more than 25% publicly traded. So, your studios and whatnot. So your non-indies are going to be like your studios, and that's going to include your television, relocating series, pilots, miniseries. And once again, that whole top part of this page, they're all non-transferable, non-refundable. And then the bottom part, independents, are transferable. Okay? And they are going to, this is a much better place than they were before because transferable didn't get as much money as they did in the last program. So they're getting more money. So that's key, and that's terrific. And now they've divided it up. So before, independents were just in this one lump sum. Like if you're a $50 million independent and if you're a $3 million independent, well, guess what? You're in the same pot and you're competing for the same amount of funding. You're competing for, now that's not the case. So now if you have a $3 million, project, you're not competing for the same funding that, a $40 million project is competing for. That is so huge. To me, that's the most important part of this new 3.0. There's a lot of changes that we're going to talk about today, but to me, that is key. because independents can now capitalize. Before, because there's something called the job ratio, which we're going to talk about, and a few other things, independents could not, they could apply. I've had clients and I've applied with the clients, and sometimes they could get through, but it was hard and it was rare because of competing with the funding. No longer the case. No longer the case. So yeah, I mean, you can look here and see, and look at the way they divided that up. The independents that are 10 million and below actually get almost $16 million, more than the ones that are 10 million and above. How unique is that? I personally think it's terrific, because once again, these small indies, what they categorize as small indies, now have a chance to stay home, now have a chance to work in California and capitalize on this program. And that's what they're trying to do. And I just think it's fantastic. I can't stress it enough. Okay. All right. I hope you guys took your sips of your drink on these asterisks here. So there's going to be more, I promise. Okay. So let's talk about these types of productions and the way they divide them up. Okay. The first one and the most broad and biggest one is non-indie features and television productions. Okay. They get a base credit of 20%. They get it on, now, what does that mean? That means that if you spend, and I'm using very simple terms here, if you spend $100 on, for example, your below the line residence wages, you would get a 20% credit for those wages. Okay. Okay. So below the line residents, non-residents, and your California spend. Your California spend. What does that mean? That means things that you're purchasing, renting, what have you, in California. Got it? All this, and this is how most states are, 99%, except for like Massachusetts and New York. Everything needs to be purchased in the state and used there to qualify. And then with regards to your labor, the labor needs to be incurred in the state. So your below the line residents and non-residents. Okay. Somebody just asked if commercials is in this. No, commercials do not apply for any of the categories we're talking about in California. They cannot apply, and they do not qualify in any realm in California. So keep that in mind. Okay, so we're moving on past this. That's the basics of that. We're going to build on that, okay? The bonuses and uplifts, because you'll see at the top, I've got between 20 and 30. That's new. That is new. And here's why, is because now they've done bonuses a little different way, okay? Before, you used to get upwards of 25% on these types of productions. So once again, non-indie features and television productions that are relocating, pilots, and things like that. These uplifts have changed, and I personally think they've changed for the better. So stay with me on this. The VFX, they get a 5% uplift if expenditures are 10 million and above. So if you meet the 10 million and above, then on those costs, you get the 5% uplift on those costs. Or if you don't hit that 10 million and above, if 75% of your total worldwide VFX costs incur in California, those costs can have the 5% uplift. So let's say you're doing VFX in other places, that wouldn't matter as long as 75% of it was done in California, okay? An uplift is a bonus. So it's the same as a bonus, and it's going to be applied to your base credit. We talked about the 20% base credit. Somebody just asked it. We talked about the base credit. This is added to your base credit. So once again, we use that $100 very, very, very simple scenario, and you get 20% back. You would get, if you use any of these uplifts, you would get 25% back, or in some situations, 10% back. Let's talk about that. So the next bonus is the out of the zone bonus. So it's a 5% uplift. Now follow me on this one, okay? It's a 5% uplift on expenditures that have to be bought, rented, what have you, and used in an area that's 30 miles outside of LA. So that's how the expenditures get the 5% uplift. Bought and used. So you can't buy them out the radius and then use them in LA. Nope. It's got to be used outside the radius. Okay. And then in terms of wages, if someone is from Los Angeles and they travel and they work outside the radius, that labor, those wages that are incurred out that radius will qualify for the 5% uplift. Okay? Did everybody follow that? Okay, cool. So here's the interesting thing. Somebody says, why does it have to be outside LA? Well, think about it. LA is going to be busy either way. And the whole point of these incentives is because they want to incentivize the state as a whole. And legislators and, politics or whatever aside, they want to make sure that the whole state is profiting from the industry, not just LA. So they're going to incentivize, that's the key of the program, incentivize other areas to say, hey, come film over here. And then you get an extra bonus because, LA is going to be busy either way. A lot of states do this. New York does this. Louisiana does this. I think you're going to see this trend more and more and more. New Mexico just passed this. So a lot of states are going to start having these out-of-the-zone bonuses outside of their main cities. Okay, now the next bonus is brand new. Look at this. Look at this. So it's kind of like the out-of-zone bonus, except it's only on labor. It's only on labor, and it's 10%. That's how you get that 30. It's 10% on individuals who live and work in that area outside of LA, that 30-mile radius. Okay? So that is the key with this bonus. Is this one is only for labor, and it's 10% for non-indies and TV productions, and it's for people that live. So the out-of-the-zone bonus with regards to wages were people that lived in LA that worked outside the radius. The local higher labor bonus or uplift is for people that live outside the radius and work outside the radius, and it's only labor. Okay? And how do you prove that they live outside the radius? They need an ID, driver's license of some sort, and a utility bill that shows that they've been there in that residence for 3 months prior to their employment with you on the production. Okay? Somebody's asking about what counties are covered in the 30-mile radius. It's a lot. I mean, they list it on the California website, which is that is the add-all be-all resource for this new incentive. It's terrific. And if I listed all the counties here, it would take up 2 slides. So I apologize, but it's a 30-mile radius. Okay, so still talking about these types of productions, let's talk about the production types and the minimum requirements. Okay, so it does include MOWs and streaming. Okay, as long as you meet these minimum criteria. MOW used to kind of have its own, that's why I have an asterisk there for new. It used to kind of have its own application type, and it used to have its own application minimum spend. I think it was lower, I believe. I think it was 500. Now everybody's at the 1 million. 1 million qualified costs. That means that you have to spend $1 million in California, whether it be in your expendables or your in-state labor. Okay, and when I say in-state labor, remember that can include below-the-line non-residents. They just have to be working in the state. Okay, you have to have a 75-minute runtime, and going back to the MOWs, there's no distribution requirements. So before you used to have this kind of thing mapped out. So MOWs, if you don't know where your project's going to end up, because look at all of our options now. You've got so much, all these streamings, and now Quibi, and like all these different types of things. Now that's no longer a factor, which is great. Once again, another good thing. This type of production type, this umbrella of non-indies and television productions, obviously includes TV. It includes reoccurring. Reoccurring means, you've done a season in California, and now you're doing another season. That season has the potential to qualify. A pilot, a miniseries, or a new series. Okay, they need $1 million per episode for the qualified cost. A 40-minute runtime. A 40-minute runtime on your episodes. And then if you're a miniseries, you need at least 2 episodes. That's how they define a miniseries. And if you are reoccurring, you need to prove your pickup order. You need to show your pickup order 140 days after your CAL. Uh-oh, here it comes, right? What's the CAL? We're going to be talking about it. It's, just so you guys know right now, it's a credit allocation letter. Okay, that will basically be when you're awarded your estimated credit from the film office. We're going to talk about it. I'm not going to leave you guys hanging with any of these terms, okay? All right, so let's move on. You're also going to need 75% principal photography in the state of California, or 75% of your total budget in California. So you could film in other places, you could, as long as 75% of your principal photography was in California, or 75% of your total budget, the whole budget. So if you're filming in New York or in other places, international, whatever, that's okay, as long as 75% of your total budget was in California. Okay? Okay, so productions, they have the project cap. This is new. It used to just be the 20%, but now because of the bonuses, they've added a potential to get an extra 500,000. So now you can get up to I'm sorry, the extra 5 for the 25 million. Okay, so that's great. The funding caps, we talked about that in the other slide, and it's scripted and studios that this applies to. Okay, no reality, unfortunately. Here's the division of the funding caps. We saw this on the wheel in the beginning. It's just showing you how much is allocated for each type. Okay, so I know I'm going through a little fast, and it's kind of broad, but there's a lot to cover, guys. There really is. So I'm just trying to move at a good pace, and we're moving on. So now we're talking about the second of the 3 types of, I don't know what you call them, buckets of this incentive. The second type is California Relocating Television. Okay, this is also a non-transferable, non-refundable credit. Remember, independents are the only transferable one. It's got a base credit of 25%. So the last bucket, the last non-indies television we just talked about, is 25%. Okay, so with 25% now, with 20%, now you're at 25% base. So that's already higher. That's great. It applies to the same people we talked about. All your below the line, basically, residents, non-residents, your California spend, everything you're buying in California. Now, with regards to the bonuses, look at this. They do not have the VFX one or the out of the zone one that included expenditures. They only have the local higher uplift. Now, in the last bucket, the non-indies and television, all the other television, if you remember, you could get 10% on that labor. For relocating television, you can only get 5. Okay, why is that? It's because they just want the max credit to be 30% overall. Okay, so it's the same rules apply. You still have to have, the 2 types of proof of residency and the 3 months prior to employment, all that, yada yada. Exactly the same thing. It's just a different percentage, and it is the only bonus that applies to relocating television. Okay. What is the definition of a California relocated TV? Somebody just asked. I'm glad you asked. Okay. So it's right here. Okay. So the same budget basic minimums are required in terms of $1 million an episode. Okay, so that applied in the last bucket when we talked about the other television shows. It applies to this one as well. It needs to be scripted, no reality, 40-minute per episode runtime. And here's what really defines the relocating right here. And this actually changed a little bit. Your most recent season must have been shot 75% outside California with at least 6 episodes. That 75% requirement did not used to be there for version 2.0. That's new. 6 episodes was always there. Okay, so the 75% is new. What does this mean? It means if you filmed like your whole first season outside of California, and now you want to do your second season in California, you would be a relocated television show. That's how you would apply. Okay, and then let's say, so that would be your season 2. Let's say you got approved for season 3. Well, now you're no longer a relocated television, you're a reoccurring, which we talked about in that last bucket of productions. So now your base goes from 25 to 20 with the potential to get, 25 or even 30 with the bonus that we talked about. But for relocating, the most you can get is the 25 base and the 30 with the bonus. Here's their funding caps. I put us asterisk here because they actually went a little down on this to make room for the independents. which we're going to talk about. Okay, so I know we're kind of burning through a little fast. Okay, I see questions come through. Once again, if I don't hit on your questions, it's not because I'm ignoring you. I do see it. I see some Quibi questions, stuff like that. I know Quibis are weird because they have short run times, and there's a lot of questions with that. This is a new program. They're still trying to get some things with regards to that going. But I will follow up with your questions. Okay, guys? Okay. 25% base and 30 bonuses means 25%. No. Okay, somebody just asked how the 25, it means 25, not off your total budget. When you see these percentages, just for everybody listening, it means off of whatever you're spending in the state, okay? And you're going to have to flag and tag everything, and that goes for every production type. So if you're spending $100 on something in California, you need to flag that in your budget. You need to flag that using your accounting system, like if you're using Media Web, our accounting system at Media Services, which we have the tools to do all that stuff with. You're going to use that to flag it, and you should get a 25, 20 to 25 to 30, depending on your production type, of credit if you apply in our welcome into this program. Okay. Okay. So this is the standout, right? And once again, I can't stress enough how I think that the way they divided up and gave independents their own pot with regards to 10 million and below and 10 million and over is so terrific. So I really want to talk about this. I'm dealing with this right now, actually. And independents, FYI, even though the program just started on July 1st, the window to apply for these productions starts on July 13th. Okay, so it's coming up. It's coming up. Yeah, July 13th through the 15th. So it's get ready. Okay, and reach out to me. I'm working already with a slew of our clients on applying, getting things in order, trying to figure this out. This is a service when using us for payroll, and everybody here, I consider us to be friends. So if you guys want to ask me questions or reach out to me after the fact, let's do it. Okay. If somebody asks about the windows, we're going to talk about them, but yeah, they're strict windows to apply. They're very strict windows to apply. 13th to the 15th for independents and also non-independents, so if they group it into features, that is coming up, and it's a very small window. It's 13th to the 15th, and that's it. There's no other window. They will add more windows as we go. So like if anybody's listening to this and it's pre-recorded on our website, because once again, this webinar is being recorded, the dates change. So you have to check in with the California Film Office to see the dates, okay? So there will be different date windows that they will put out. Right now, there's one coming up for features. Okay, so let's get into independence. Somebody asked, is there a deadline for television series? It already happened. Isn't that crazy? It happened on June 22nd. The window was open, okay? Somebody asked if the applications are first come, first served. We're going to get to it. Okay. So independence, fully transferable. Remember what we talked about. So that means you can sell it on the open market, get your cash back fast, get that going, so that you can hopefully pay back your debts and all that good stuff. Okay. What's the base credit? It's 25%. So 25% on the residents, 25% on non-residents that are below the line, and 25% on your spend. Okay. And we talked about the spend and what that is. So you get 25% back, and it's transferable. They have bonuses as well, but it's just like the relocating television. They do not have the VFX. They do not have the out of the zone that includes expenditures on people from LA. It's only the local higher labor uplift, which is brand new, and it's only 5%, just like the relocating television. Okay, so this bonus right here that you're looking at on your screen, this is carried through all the buckets of production that we've talked about today. This is the last one. This is 3 of 3, independence. Okay, so the difference is for the first bucket with non-independents, it's 10%. For relocating and independent productions, it's 5%. And that's because the base for independence is higher. Starts at 25 as opposed to 20. Okay. Still need your proof of residency, driver's license, ID, a utility bill from 3 months prior to employment. And once again, Individuals living and working outside the radius. Very, 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 very important. Okay, so nobody from LA for this bonus. Okay, so once again, right here, that right there is my favorite part of the new incentive, is the way they've done this. Because so many of my clients are 10 million and under that are coming to me saying, you know, how do I do this? What do I do? And we have applied, and sometimes it just doesn't work because they were competing for, I believe it used to be 5% of the pot of the 330, and with independents that were 50 and above, or, you know, 40 or whatever, and they're 3 million, 5 million, 12 million, whatever they are, okay? But they were competing against large independents. It's no longer the case. So if you're small, you're in the small pot. If you're above 10 million, you're in the larger pot, okay? Here's the funding they have allocated. We talked about that, and I just love this. So I know you guys already saw this in the pie that we showed at the beginning, but I just love the fact, okay, the asterisk, I talked about this in the beginning, is anytime you see something new to the program, it also means you should take a drink or take a bite of what you're eating, okay? Let's have a little fun. I mean, there's a lot of information. I really hope you guys are absorbing all of this, because there's so much to go through, but we're hitting it, right? We're hitting it at the levels. And once again, if anybody has a term they're not sure about, you know, hit up in the question box right there, okay? So there's a division. And once again, I just love that 10 million and under got more than 10 million and above. Nothing against those independents. I love them. I have a lot of clients there. But I just felt 10 million and below just really didn't have a shot in the past, and now here it is, okay? Here it is. So the minimum requirements, just like before, with pretty much this applies to every production, the $1 million qualified cost, the 75-minute runtime, and then the 75% principal photography or 75% of your budget in California, just like in that first bucket we talked about with non-independents and TV productions, okay? So you can film other places as long as that either or scenario goes into effect, okay? Your whole budget or your principal photography, okay? All right, so, wow. I mean, that is like, I'm burning through that with regards to the overview of each of these types, okay? But there's a lot that's changed on other ends of the program. So I want to move on to the application process, some new reports that they're talking about, new requirements that you have to have for all productions, for all buckets. Okay, so this is going to apply to everybody listening, no matter what you're doing. Okay, is there any more questions in regards to independence before we move on to that? With regards to like the transferability of it, we're going to talk about how to transfer it. We're going to get into that. Okay, but in terms of the basics, you're looking at it on your screen. Okay. You have to have all your funding in place before you apply. They do want a finance plan in the application. Yes. Okay. Will these dedicated allotments make it easier for independents with tax credit financing? Yeah, absolutely. Absolutely. Because you're going to get your allocation letter, which we're going to talk about right now, and you have more of a shot to get it. Once again, 10 million and under, they could technically get it in the past with 2.0, but now that 10 million under has its own pot of money, and it's not small, it's a nice size for that type of production. That's going to be something you can show to your financiers. Okay. So the application process for everybody, the short version, okay? And we're going to talk about these terms, okay? There's a lot of terms in here. I don't want them to fly over everybody's head. This might be the first time you're even looking at the California incentive because they've opened up these new windows, because now they're allowing for independents to capitalize on this. So I want you guys to just kind of keep up with me, and don't worry, I'm not going to leave you hanging with these terms, okay? The initial application window. So this is the first application. This is on their website. This is what's considered phase one. And they're going to want what's called a jobs ratio. You're going to hear this term a lot when you go to their website, when you have to apply. This is always going to come into effect, and we're going to talk about in detail, well, as detailed as we're going to get on this, what the jobs ratio is, okay? Projects in the top 200% of the jobs ratio will move to the next phase. Now look at that. Does that look funny? Does that look funny on your screen? So I just had a client, and we're going through their budget right now, and I was explaining to him everything. And he said, what in the heck is top 200? How can you have the top 200 of something? How does that even make sense? And I explained it to him. I mean, they kind of lay it out in their bill, if you go through their bills and their legislation. So top 200%, that's what they call it, okay? But what it basically means is, let's take the independents, the 10 million and below, for example. I think they have I think we said they had like 15,800,000, whatever it is, allocated. We'll round that up to 16 million, just for the sake of this explanation. They will allow, for independents, 10 million or under, they will allow applicants upwards of 32 million to move on to the next phase. Do you see what I did there? So if I'm saying that there was 16 million in the pot to allocate out to potential applicants, they will accept, not 100% would be the 16 million worth, right? 200 is double that. So 200 would be the 32 million worth of applicants that they're going to in credits that they're going to allocate out. Okay, and that's just to get to the next phase. So once they have that top 200%, they go to the next phase. Okay, they're using the jobs ratio to get people into that top 200, and we're going to talk about what that top 200 is. Okay, so the next phase is, once they've accepted their top 200%, they're going to ask for more application forms, your budget, scheduling, your screenplay, if you have a pickup order for for your reoccurring, if you have any affiliates, yada, yada. They're going to ask for more and more information from that top 200, okay? And then once they have that and they review it, they're going to narrow that, they're going to cut to what is allocated out. So in our example, the 16 million for the independents, 10 million and below. Once again, I'm rounding up because it's 15, 8, whatever, but you guys follow me, okay? So now they're going to allocate out the top 100%. So they're going to get rid of half of the applicants after phase 2 of the application process. Half, okay? So just because you make it to phase 2 in the top 200, you're still not in the clear. It's really phase 3, where they take the top 100% and they said, okay, here's all of our money. We have 16 million and we have it allocated out to these people. And they're going to allocate it out in CALs, which we talked about this earlier, the California allocation letters. And the allocation letter is basically going to show you how much your estimated amount you'll be getting back in your credit. And to the person that asks about financing, we'll just make it easy. When you get your CAL, that is what you're going to want to show your financiers. That is what the independents are going to want to show. They're going to say, look, I've passed the application process. I've gotten here. They are giving me X amount of dollars at X amount of time if we can finish this film. Okay? So somebody just asked how long the CALs, whenever I say CALs, I think of like a calzone. I guess I am hungry. I guess I am. So I'll just call it the letter. How about that? So I don't make it, maybe I should have a calzone for this. No, I'll say that for another state. But so you must begin principal photography within 180 days after the CAL is issued, after the letter is issued. Okay? You will need a funding plan. Yes, somebody's asking about funding plans of finance. You will need all that in these initial application forms we're talking about. Once you get this letter, you're good. Obviously, you still have a lot to do with the application and doing everything correctly. But once you have that letter, I mean, that's a golden ticket. You can say, look, I've passed 3 phases of the application process, and I have the letter that says that they're bringing this, that I'm going to get it if I do everything correct. Now, what is new about this is if your budget is over 100 million, they now allow you to begin principal photography with 240 days as opposed to 180. Okay, so that's a little change. After principal is over, they have another check over of all your documentations. Okay, so they're going to be going through, your call sheets and career readiness stuff. I know everybody's like, what the heck is that? We're going to talk about it. There's going to be a couple other reports that we're going to talk about on the next page that all play into this, but it's just going to be more basically final checks and read-throughs. And then phase 5, look how short I made this. This is like 6 pages worth of stuff. So you guys, when you see final docs and you're like, oh, that sounds easy. It's a lot of stuff. Okay. So phase 5, that's your, post your audit. You're going to want a very good auditor. I work with David Brower a lot. We were talking about this program, and he recommended I talk about breakfast burritos on this on this webinar. And he said there's a great one in Studio City at the farmers market on Sundays. And I would not argue with him, but I said we've already kind of done burrito style stuff in the past, so I went with the avocado toast. But David, if you're listening, I definitely, you made me hungry for a burrito. So there you go. I mentioned to you. But you're going to want a good auditor. They're going to go through everything. They're going to go through the job. They're going to verify your jobs ratio. So what you turned in at the beginning of the application, and we're just about to talk about job ratio, they're going to verify your numbers. Okay. So, and then you get the certificate, you would get your credit. Sounds so easy. Okay. But, there is a process. So let's talk about the jobs ratio. Okay. What is it? It is an equation. And you can see on I took this from the California Film Office website, terrific resource, the best resource for this information. You're going to the source. I can't stress that enough. Okay. And you can see here how it works. It is an equation where they take your qualifying wages, your qualifying expenditures, and the expected credit. Okay. And they do that equation on the side with 35%. They're dividing it by the estimated credit, and they get your base jobs ratio number. Okay. This is extremely important. This is going to be the first thing you do in the application process. And by the way, they have a calculator on the Film Office website, which is great. It's an Excel file. It downloads to your computer. So you can play with it. You can put all the different numbers in there, try to figure it out, and make sure you're doing it accurately and correctly. It's very important. We're going to talk about why. Okay. So you're able to get bonus points. So once you get that base job ratio number, you can add to it to make your project more enticing to the Film Office to incentivize it. Somebody just asked with regards to, is it first come, first serve with the application? No. That's why the jobs ratio is so important, because that's how they pick that top 200 we talked about and narrow it down to the top 100. Okay. So you can add bonus points, as you can see on that image on the side. So how do you get your bonus points? There's different ways. There's 3 different types. They're like bonuses, okay? But just for the jobs ratio, okay? You can do VFX, music scoring, or out of the zone. So depending on your size of budget, what type of production you are, so if you're television, independent, feature, relocating, all those things play. They have like a chart that helps you figure out how many points you're going to get. And how much money you spend on the VFX, you would get a certain amount of points. Same with scoring, and then out of zone, it's based on how many days you're out of that radius we talked about. Okay, and that's how you build up your points. If you're 10 million and less, take note. The only bonus point that can affect your base job ratio is the out of the zone percent, is the how many days you're out of the zone to help build up your jobs ratio. The VFX and the music and scoring do not come into play if you're 10 million and below. Okay? Now, I know I went through the jobs ratio kind of quick, but that's the overview, just so you guys understand it, so that when you hear these terms and you go to the website, you say, jobs ratio, what is that? I'm trying to figure it out. I need somebody to spell it out for me. That is it. It's an equation. There's the equation. You can add bonus points to it. It's basically building your case with an equation to say, I think I'll qualify in California. Let's see if I do. And you put in this equation. Okay? Any other questions about the jobs ratio? This will be pre-recorded, yes. Okay, VFX music scoring are less than 10 million. No, so it does not apply. So once again, if you're in those independents that are 10 million and less, you cannot use the bonus points of remember, this is not bonus on the credit. We already talked about that. That's separate. This is on your application process. This is to make your jobs ratio better. You can add points. And the 10 million and below cannot utilize the bonus points of VFX and music scoring, only the out of the zone. Okay. Okay, some universal new truths. There's a lot of these. Okay, and we're going to go through them. So there is now a diversity initiative requirement. This happens in phase 2 of that application process we talked about. This does not apply to 10 million and under. It's waived for them. Okay. But you basically need to have a plan. You need to have some sort of plan, an initiative to show that you're going to be hiring minorities and women and any type of, the minority group. You need to show some effort to show that you're going to be hiring them on your production. Okay. So we can add these forms if you're using Media Services, for example, for payroll, and we use TIM for digital onboarding, digital I-9s, and you can upload all kinds of other paperwork to it fairly quickly. You can add these types of forms to it. Now, as the production, you're required to do this. No question about it. You're required to do it. You're required to show the tracking, okay, to show that you tried, and then whatever information you get, you're tracking. However, when you give it to your employees, when you give it to your crew, you can't force them to fill it out. You just can't. If somebody, doesn't want to divulge their gender or their ethnicity, that's their right, and they don't have to fill it out. You just have to show that you're putting out that effort, okay? The unlawful harassment policy, once again in phase 2 of the application process we talked about, kind of the same deal. So this is all, and all these are brand new, by the way. These are all brand new. This was not in 2.0. The unlawful, so like this whole page, like if you guys are still playing my drinking game and like whenever you see an asterisk, like just down it, like just do like 3 shots or something right now. We're talking about all new stuff. So the unlawful harassment policy, you need to show how you're going to educate your crew, what the repercussions will be if there is harassment on set, you need to tell the film office how you're going to distribute it to your crew. Once again, using TIM, digital onboarding, that's something that we can help implement it by adding forms and what have you to your digital start forms. Okay, so it's a terrific tool when using that. The pilot program, this is new as well. Okay, so think about that application window we talked about when you were issued your California allocation letter. I just don't want to say Cal. I don't know. Calzone. I guess I'm just a foodie. When you're issued that letter, okay, you have 10 days to pay. The applicant pays 0.25% of your estimated credit. So whatever's on your letter, they're saying you will get X amount of dollars. You have 10 business days to pay 0.25% of that credit to the pilot program. Okay. Yes, it's the credit allocation letter. That's what it is. Yes. Okay. This is, and look, I don't want to confuse you guys. This isn't like, they call it the pilot program. This isn't on like pilots, TV pilots only, or any of this type of stuff. It's on everybody. They call it the pilot program. Okay. So that goes towards, that money will be funded towards people in what they define as underserved communities and their training and education in our industry, and hopefully we'll expand upon that. So that's the goal of it. Okay. But it's a requirement. So be prepared to pay it. Okay. Okay, that's the pilot training program. Okay, so the local community expenditures report. This is a report. This isn't brand new, okay, but there is a big change to it. This is a report that you have to turn in during phase 4 of the application, and they changed this. It used to be that when you would do this report in 2.0, you would have to report, if you spend $100K, so $100,000 in any county outside LA, you would have to report it and track it. okay? No longer the case. Now they've gone a step further, and in 3.0, you have to track every single dollar in every single county that you spend outside LA. Once again, this goes back to what we were talking about when they were saying, oh, when somebody mentioned why does it have to be outside the LA radius? They want to incentivize those areas. They want those areas to get the benefit of having productions in our industry be there. Okay? So it's very important that they want to track every single dollar. And they have on their website all the tracking tags that you will use. And there's a lot of them because they have a tag for every county. They actually have a whole document that I recommend everybody look at that's strictly on tagging. And it's about tagging your budget, tagging and your accounting system. And MediaWeb allows for all of that. MediaWeb will allow for you to tag these things using what's called free fields. If you guys don't know what free fields are, it's free. It's basically a free cell when you're doing your accounting in our system, where you can put in tags to say, oh, you filmed in this county. It's usually a 2 initial tag, okay? And you're going to be using that throughout the whole course of this process, whether you're in your budget, so like you're using Showbiz budgeting or Movie Magic budgeting, you're going to want to use certain tags that they give you, okay? Showbiz budgeting is our budgeting tool. All of our clients get that for free. MediaWeb is our accounting system, and all of our clients get that for free as well. And it makes this process a lot easier. The Career Readiness Program. So they had this before, but once again, they changed it. So this is basically like hiring interns and people from college and high school to come on set. A lot of times they are paid interns. They do allow for that. And I mean, that's just becoming the trend. I was speaking with our business, our labor relations guy last week, and he basically told me that you know, the free intern, what do you say? He said the world of the free intern is pretty much over. So like people are just paying their interns. So, and by the way, our labor relations department is terrific, and all of our clients get access to that to help with unions and any type of questions regarding labor and who you're paying. So keep that in mind. You're always going to want a good payroll company. So with the career readiness, before, you would have to spend at least 225 hours. So with your interns would have to spend at least 225 hours on set, okay? And that was a deposit. If you paid them for those hours, none of those wages were qualified. Now in 3.0, so ignore what I said, which is great, it's a 300-hour requirement. However, all those 300 hours can qualify if you're paying them. Okay. Before, you had to go over the 225, and then anything over that would qualify. Now, everything. So all 300 hours can qualify, and it's 100 hours per person. That's the cap. So at your schools, your interns, all that good stuff. Okay. And then the jobs ratio penalty. They had this before, but they changed a little bit of it as well. This is at the end. Remember we talked about in phase 5, they do verify your jobs ratio. So it does come back into play. It's extremely important. So if you feel like, oh, I'm going to play around with this jobs ratio, I'm going to add this and add that and add these bonus points on there, and they'll never know, they will know. They're going to verify everything. And if you push the boundaries of it, and if you, let's say your jobs ratio isn't as high as you said it was, if you get to 10% or higher, they're going to reduce your credit by the same amount that you reduced your jobs ratio. Okay. Somebody's going back to the interns, $100 a day, $300, no, 100 hours per person. You can pay them whatever, I don't know, whatever the industry standard is, or however you feel for the interns. But they need, it's 100 hours. That's the max that one person can get. So you can't just pay one intern $300, but you've got to hit the $300 hours. I'm saying hours, not dollars. Sorry. Maybe I had too much of this mimosa. I'm just joking, guys. Okay, so with the penalty, if you reduce your jobs ratio, if it turns out when they verified everything that you made it seem too big, you inflated it in the beginning, and now all of a sudden there's a reduction of 10%, then let's say it's 11%, just for the ease of this. So if they say, oh, your jobs ratio wasn't as high as you said it was, it's actually 11% lower. Whatever they have allocated out for you with your credit, they're going to reduce that by 11%. Okay? So your jobs ratio needs to be accurate. Use the calculator. Use your correct numbers. Try to be as accurate as possible. If you go over 20%, which I don't believe they have, but if you did, then not only do you get the penalty, but you're also not allowed to apply from whenever they decide that, oh, they did this, their jobs ratio is way under. When they decide that and it's over 20%, then you can't apply for a year to that day. So you're pretty much banned. Okay. With regards to the phases on this goes back to the application. Okay. I just have them located where they do apply in the application process. So when you see phase 2, phase 4, that's going back to the application page we talked about, because there's 5 phases of basically the whole application and incentive process, from you first applying to you getting your credit. Okay, so that's what that means. Any other questions on this slide, or all this new stuff that is on the new application process? Okay. What does universal new truths mean? I just mean that this applies to every single production that we've talked about today, and every single production that, except, you see that right there, the diversity initiative does not apply to 10 million and under. But this basically applies to everybody, and it's new. All these are new in some way, shape, or form, whether they're brand new or they've had changes. Okay. Okay, so I've had just 3 questions back to back about the pilot program. It's a training program. All you need to know, for the sake of you being a producer, is you have to pay. You have to pay. If you get that allocation letter, you need to pay 0.25% of whatever your letter's saying you're going to get. So if they say you're getting X amount of dollars, you have to pay 0.25% in money up front to the pilot training program. That training program it's basically to better the communities, to better underserved communities, and teach them and educate them in the industry, to hopefully they can be part of California's crew base. Do you understand? So it's not a penalty or anything like that, but it is a requirement. A lot of states do this. They have some sort of career program to do this. Now, they do have the career readiness program already, but this is a guaranteed, you're putting money into the pot towards this new program. Okay? You have to pay it. Somebody said they looked at it wrong and they thought it was 25%. that would be a whole different ball game if it was 25%. It's 0.25%. Okay? Okay, so all that's done. Yippee, yippee. All right. Yay, we did it. We got through our production. We did our application process. We got through the audit. We got awarded the credit, sir. So what do we do next? Okay? If you're a non-indie feature television, just like we talked about in the very beginning, you can offset your income tax liability. Okay? So like studios, for example, they're going to have a lot of tax liability in the state. And since they can't transfer it, remember, non-transferable, and they're not getting cash back from the state, it's non-refundable, that's what that means, they can only use it to offset their tax liability. Okay? So they can also use it to offset sales and use tax. And this comes in handy with affiliates. Okay? So affiliates are, if you guys don't know, a lot of times with studios and what have you, they're related parties, and you can assign them the credit on the application. Okay? It's not transferable, but it's being assigned. It's being assigned. Okay? And when you go to use these credits to offset the liabilities, they can only be used $5 million per year at a time. Now, let me say that again. So if you got $10 million back in the California credit and you were offsetting your tax liability, you could only offset $5 million. And then you're going to have to hold on to the other $5 million for next year. Okay? Cool. Okay. Independents, on the other hand, are transferable. That's the big thing. So you can offset, they have the option to offset their liability, just like the non-indies and TV. But they typically, usually independents don't have that liability. They're not gigantic studios. They're not, it's a producer, what they usually don't have state income tax liability. So that's why they want to sell it. Okay? So you're going to want to sell it to somebody in California that has liability. That's why they're buying it. And it's like a Groupon. Talked about this before. So like they're going to buy it at you. Once again, the going rate was 94 cents on the dollar before COVID and all this stuff. Hopefully it's still strong when we come back. But they would buy it for 94 cents on the dollar. So if they're buying $100,000, they could buy it for 94. They're saving $6,000, and they're going to use it to offset their tax liability. Okay, and once again, they have the same limitations we talked about with the claim cap. Whoever buys it, so you don't have a limitation on how much you could sell. You can sell all 20 million to a buyer, okay, at once. That'd be great. But the buyer, when they go to use it, they need to be aware that they can only use it $5 million a year at a time. Okay, but it can carry forward. What's a carry forward? That means that if they don't use it, so they have leftover credits, they can carry it forward. And in 3.0, the transferable credit carries over for 9 years, which is an increase from before, which is great. So that'll make the credit worth more, hopefully, because it can be carried over. Okay? All right. Whew. Let's wrap this up, guys. Okay, so here's some kind of last tips and hidden facts and things I think you guys should take note of. Okay? The fringes. So they have also on their website called the Fringe Matrix, which breaks down all the fringes that qualify, how you should tag them, how they want to see them tagged. It's called the Fringe Matrix. Be on the lookout for it because they're going to want to see it. That's going to be in one of the application processes, all those documentations and those reports. That's going to, in one of those phases, they're going to ask for that. I can't remember what phase it is off the top of my head. Okay, none of your federal fringes will qualify. So keep that in mind when you're working on your budget. Okay, this is really interesting and brand new. Prorated wages. So as we talked about, and somebody asked about above the line, so now I'm getting to it. No above the line will qualify. That's a fact. Okay, but especially in the independent world, sometimes you have people pulling double duty, and sometimes you have somebody that might be working at below the line. Whatever, a below the line position one day and the next day they're a supervisor or something that's considered above the line. So they allow you, that's considered they might be a producer. That's considered a producer hyphenate wage split. And they will allow you to, if you can show, and we're able to do this in our reporting with Media Web, if you can show the split of below the line versus above the line, then the below the line wages will qualify upwards of 100K. That's the only time a compensation cap comes into play. A compensation cap means that they will only allow for somebody to qualify their wages up to a certain amount. A lot of states have these. But the only time it comes into play in California is with the producer hyphenate wage splits, and it's their first 100K of pay on their above the line position. Pretty interesting. Pretty interesting. They have a new chart of accounts. It's all listed out. There's a lot of changes, a lot of new stuff for the new world. There's a whole section with COVID and safety officers and all that type of stuff when they do qualify, and they tell you how to tag them. Airfares, and only within the state, so nothing out of the state, and it has to be booked through a booking agent in the state. Box rentals, meals, cars, these used to be categorized and tagged differently in the past. Now they're just considered part of the wages. Okay. So there's a lot more. The chart of accounts goes through a lot, and they do it very well on what's new and what's not. And then don't forget, on the chart of accounts, you've got all these new bonuses, especially the labor bonus that we talked about, that local labor bonus, which is going to be extremely important in going through your budget. All of that needs to be tagged. All of it needs to be tagged. Whether it's in your budget, well, it does need to be tagged in your budget, and needs to be tagged in the payroll accounting system. Every place you can use the tags, you need to flag these things. And they do tell you on their website how to flag it, what to initial flag to use, and with using a payroll company like Media Services, and using our tool, as we mentioned, Showbiz Budgeting, and Media Web, our accounting system, which is cloud-based, you're able to do those types of things. We offer quite a few free fields you're able to put in, because most of these things will need double tags, triple tags, mostly double. Okay. And same with your budget. Your budget, I mean, most of these things will have double tags, especially if you're taking advantage of the out of the zone bonuses or the local labor bonuses. Okay? You can call me with any questions with regards to using us as a payroll company or using our software and how that's implemented for our clients. Okay? During that last phase, there's a final element verification report that they want, where they verify everything. They verify all your costs and your wages and all this type of stuff. I found this kind of interesting while reading through everything. There's a 30-day window, like a grace period, during that verification time, where if the service is performed within that window, it'll still qualify. Not paid for, but the service has to be rendered. Pretty cool. Okay. And once again, I cannot stress enough how terrific the California Film Office is, and everybody over there with this new program and what they put together. I'm beyond impressed. And their website is full, and I can't underuse that term anymore. I mean, it's just it's so full of information. There's so much to go through. And look, it can be intimidating too. So that's why I'm here for our clients, and even you guys all listening. I put myself out there to say, if you guys want to go through this on like in layman's terms and at the macro level, where we can kind of talk about it so you see what's to expected, where it is. If you're intimidated by looking at all these things to read and videos to watch and matrices and forms, we can do it together. Okay? Okay. Well, we did it. We only went 10 minutes over. Whew. I'm impressed with myself. Just because of 10 minutes over. It's not bad. And because I ate all my avocado toast. Hopefully you guys did too. So this is my contact information. Once again, do not hesitate to reach out to me. I'll take any last questions real quick that I think are pertinent to answer here. If not, do not worry. Once again, I see all your names. I see all your questions. I am here for you guys. I will be reaching out to you directly. And this webinar is being recorded. So anybody that wants to rewatch it, you'll get a link sent to that, to the recording as well. Okay. So feel free to call me directly, email me, follow me on Twitter, all that good stuff. Okay. Okay. One person asked, indie films, or is it only 10 million and less? No. So independents are, it can be anybody that is not considered where 25% of their production company or the company that's applying or whatever is publicly traded. So it can basically be anybody. However, they've divided up the independent pot with 10 million and under. They get a certain amount of allocation of money, and 10 million and over, which is just key to this whole thing with independence, because the 10 million and under get their own pot, and that's just awesome for the small independents. Okay. All right, guys. All right. So I just want to be clear that anything that you guys have and that you're curious about, please email me and reach out to the film office. Once again, they're terrific, and I can't stress that enough. So I'm gonna call it a day with this one. I'm gonna call it a brunch. I'm gonna say that it was a good one, and I like my recipe today. I hope you guys enjoyed it. I hope you enjoyed the mimosas and the information, and let's go. All right, guys. Till next time. See ya.